Some big numbers coming out of the housing market today, and they're not looking pretty if you're looking to buy or rent.
Credit scores, down payments, and debt to income is all factors that determine your mortgage loan amount. However, knowing how much you can afford goes beyond these factors if you want to live a comfortable life. So in this video, I want to walk you guys through on how much house you can afford without you feeling like you bit off more than you can chew in the long run. What's up, thinkers? Chris Robinson here, reminding you guys to like this video before we get started. Otherwise, I'll just stop the video here. I'm just kidding, guys. Let's get into the video. So in order to calculate how much house you can afford, you need to take into account all of your finances, including your obligations. You want to first start with your income, and then you want to factor out all of your debt, and this can include anything from your car loans, student loans, or even credit card debt. Not only do you need to factor out all of your debt, but you also want to take into account of your other obligations like your food, your utilities, insurance, as well as a possible small savings just in case of emergencies. And many advisors suggest that the 28 to 36% rule is a great baseline to determine how much you can afford each month. This means that you should not pay more than 28% of your monthly income on your housing expenses, and your monthly debt should not exceed 36% of your monthly income, and this also includes your housing expenses. And to give you an example of what this may look like, let's just assume you make close to $50,000 a year. This means your monthly income would be around $4,167, and 28% of that will equal to $1,166 as well as 76 cents, and this would be considered your preferred mortgage payment. However, lenders see the 36% as a rule for your debt to income ratio, meaning you should not have monthly debt exceeding 36% of your monthly income in order to successfully afford your housing expenses. As for my personal opinion, I believe this rule is a great metric for managing your budget as well as maintaining good financial health. So keep in mind, your debt to income ratio will be a big decision factor on determining on how much you can borrow. The banks really want to make sure that you can afford it because you are expected to pay all of it back. So if you have a lot of debt, don't expect much when it comes to your approval. However, as a side note, depending on your credit score, you may be able to get approved for a higher debt to income ratio than the 36%. However, on the other hand, you are still expected to make mortgage payments not to exceed 28%. So like I mentioned before in a previous video, it's recommended to calculate all of your monthly costs along with your mortgage. For example, you need to estimate your maintenance costs just so that you can keep up with the well-being of your home. You also need to consider every bill and living responsibility outside of your mortgage payments, and this can include anything from your utility bills, food expenses, and etc. Failing to do your due diligence can put you in a rut and possibly cause you to foreclose on your home, which can also be detrimental to your credit. Okay, so we can't discuss how much house you can afford without discussing down payment, because down payments can help put you in the position that you want for your monthly payments. So it's important to know that the bigger you put down for your down payments, the better your rates will be for your mortgage terms. Also, as a side note, lenders follow something called a loan to value ratio, which determines the price of your loan to the value of your home. If your down payment is significant, it will lower this ratio, which lenders like to see. And this is because this lowers the risk that they take on from the loan. However, although a large down payment will be considerable, it does not necessarily mean that you will not get approved if you don't have a down payment at 20% or above. That being said, let's move on to discuss other programs which allow you to qualify for a mortgage loan with small down payments. Okay, so you may be wondering, how much could I get approved for with a FHA loan or a VA loan? So let's get into the details of both, starting with the FHA loan first. A Federal Housing Agency mortgage, also known as a FHA loan, is available to home buyers with a minimum credit score of 500 and above. This type of loan will allow you to get a home with a smaller down payment. The minimum down payment is about 3.5%, but this depends on factors like your credit score. A Veterans Affairs mortgage, aka VA loan, is available to eligible military members whether you're active or retired. This type of loan requires no down payment, and specific family members may also qualify for these same benefits. If you are someone who qualifies, you may expect to get into a new home without breaking your bank. Alright guys, so that concludes our video for today. If you found this video interesting, you may want to consider my video in which I explain on how you can prepare your credit for a mortgage. That's my cue, guys. I see you in the next one. Peace.